want you to imagine you're driving back from the carnival holiday, right? It's 2020, you're in the car, on the highway, and maybe you've still got a little bit of confetti stuck to your
Oh,
shoes.
yeah. Best feeling in the world, trying to shake off that carnival hangover.
Exactly. And your brain is, slowly trying to boot back up. You're thinking about spreadsheets, your accounting classes, going back to work.
Reality is calling.
Right. So you turn on the radio, and suddenly the news anchor announces that the Ministry of Health just confirmed the very first case of a brand new virus here in Brazil.
Man, just hearing you say that kind of gives me chills.
Yeah, it's wild to think about. I mean, the world as you knew it up to that exact second, it just completely changed.
It really did.
And while the whole society is scrambling to figure out, what this means for public health, there's this parallel universe where billions of rays are about to change hands in a matter of literal minutes.
Yeah, the market doesn't wait for anyone to process their feelings.
No, it doesn't. And that's what we're looking at today. What actually happens on the stock exchange in those first completely chaotic, decisive 15 minutes of a massive black swan event?
It's basically the exact moment where rigid financial theory just violently collides with human panic. Oh, and the absolute coldness of trading algorithms.
A perfect storm. Welcome to another deep dive on pod accounting.
Glad to be here, as always.
So before we jump into the charts and the risk models, I really need to highlight that this deep dive is a special activity developed for the graduate accounting program at UFPE, the Universidad Federal de Pernambuco.
A fantastic program, by the way.
Truly. And we've got an absolutely fascinating mission today for all the accounting and finance students listening. We are going to unpack a really brilliant PhD thesis written by Ricardo Ferreira Dantas.
Right, and we should mention his advisors, too.
Yes, of course. The thesis was advised by Professor Dr. Vinicius Gomes-Martins and co-advised by Prof. Dr. Giuseppe Trevisan.
That's an incredible piece of research.
It really is. Basically, what this research does is it takes a massive magnifying glass, like the microscope really, and puts it right over the behavior of investors on the B3 stock exchange on that exact day, February 26, 2020.
And, that scenario you described in the intro, the whole driving back from carnival thing, that wasn't just a fun narrative trick. It's actually the core of why the methodology in this thesis is so genius.
Wait, really? How so?
Because February 26, 2020 was Ash Wednesday, or Quarta-feira de Cinzas. And for anyone studying empirical finance or market microstructure, that specific timing is basically a researcher's absolute dream.
Okay, you're going to have to explain that to me. Why is Ash Wednesday so special for a researcher? What makes it different from, I don't know, a random Tuesday or Thursday?
Right, so it all comes down to the mechanics of how the B3 operates. On Ash Wednesday, the stock market in Brazil runs on a special holiday schedule.
Ah, right, because half the country is still recovering.
Exactly. The trading session doesn't open at 10:00 a.m. like it normally does. It opens at 1:00 p.m.
Okay, so a 3-hour delay.
Yeah. But remember, the news of the first confirmed COVID-19 case broke in the morning.
Oh, wow.
So you have hours and hours of morning news broadcasts, WhatsApp groups blowing up, social media panicking, and brokers frantically typing up quick risk reports.
So the pressure is just building and building.
Right. The psychological and analytical pressure was accumulating all morning long, basically like a pressure cooker with the valve completely stuck.
Okay, I get it now. Because if the market had been open when the news dropped, say, at 10:15 a.m., the shock would have been sort of diluted as the hours went by.
Exactly. People would buy and sell as the news slowly trickled out.
But since the doors were literally locked, everybody, from the fastest high-frequency trading robot to the regular retail investor sitting on their couch, they all had to make up their minds before the opening bell even rang.
And when that bell finally rang at 1:00 p.m., the dam just broke all at once.
That's crazy. It's like comparing traditional daily stock analysis to, I don't know, looking at a car crash the next day. But what Ricardo did here is like setting up a high-speed slow-motion camera right at the exact millisecond of impact.
That's a perfect analogy.
Yeah.
And that's why he made this crucial methodological decision. He didn't look at the closing price at 5:00 p.m. or 6:00 p.m.
Because by 5:00 p.m., the story's already changed, right?
Completely. By the end of the day, the government might have issued statements, the central bank might have stepped in, the dust is already settling.
Too much noise.
Exactly. So to capture the pure, unadulterated impact of that specific information shock, he used ultra-high-frequency data. We're talking about evaluating the market in 15-minute trading intervals.
Okay, that makes total sense. But if I put myself in the shoes of a grad student listening to this right now, I have to ask about the scientific rigor here.
Sure, lay it on me.
How does the author actually prove that the chaos in those first 15 minutes was exclusively because of the COVID-19 announcement?
Ah, the causality question.
Yeah. I mean, markets are always kind of volatile and weird after long holidays anyway. Couldn't it just be a normal carnival hangover mixed with, I don't know, people closing out positions or adjusting their portfolios? How do you separate the virus from the regular market noise?
And that, right there, is the beauty of applied econometrics. Ricardo didn't just point at a chart from 2020 and say, hey, look, the line went down.
Right. That wouldn't fly in a PhD defense.
Definitely not. He used some really robust models, specifically regression discontinuity and something called difference in discontinuities, which we usually just call diff and disc.
Diff and disc. Okay, that sounds like a tongue twister. Can you break that down for us?
Yeah, so simply put, regression discontinuity looks at the immediate jump or structural break at a specific cutoff point, which in our case is exactly 1:00 p.m. on February 26th.
Okay, so looking at the exact ledge where things dropped off.
Right. But to clean out that carnival hangover effect you mentioned, he used the difference in discontinuities part.
How does that work?
He took the market's behavior on Ash Wednesday of 2019.
When there was no pandemic.
Exactly, a totally normal Ash Wednesday. And he compared the 2019 opening jump to the 2020 opening jump.
Oh, I see. Let me see if I'm following the math here. The model basically says, okay, we know every post-carnival Wednesday has a natural baseline volatility. Let's call that X.
Yep, you're tracking.
And then we take the crazy volatility of 2020, which is Y.
Yeah.
We subtract that normal baseline X from Y, and whatever is left over is the pure isolated impact of the COVID-19 shock. Is that it?
You nailed it. The diff and disc creates a perfect temporal control group, and the results that were left over after he ran that filter, they were pretty terrifying, honestly.
So what exactly did the high-speed camera capture at 1:00 p.m.?
It captured quantifiable panic. Immediately after the opening, the market saw a violent drop in prices and just a massive, explosive spike in trading volume.
How bad was the drop?
Just to give you an idea, the industrial goods sector plummeted by about 12% in those initial moments.
12% in 15 minutes.
Yeah, and the volume exploded because in a scenario of absolute uncertainty, all the market agents have to recalculate risk premiums and the cost of capital for these companies in literal fractions of a second.
Wow. But this is where things get really fascinating for me. Because if the price drops 12% in minutes and volume hits historic highs, that obviously means a ton of people are panic selling.
Right, selling everything they can.
But the market is a two-way street, right? For every single share that someone dumps in a panic, somebody else has to physically press the buy button on the other end.
Exactly. The market isn't just a single monolith.
Right. So who is doing what? Who is selling, and who on earth is buying during a 12% free fall?
And this is where the thesis really shines. The study doesn't just lump everyone together into one big bucket called the market. It actually categorizes investors by their level of sophistication.
Okay, sophistication divide. Break that down for me.
So on one side, you have institutional investors. These are the pension funds, huge investment banks, asset managers, hedge funds.
The so-called smart money.
Exactly, the smart money. They are highly sophisticated. They have massive teams of analysts, ultra-premium information terminals, direct fiber optic connections to the exchange, and high-frequency trading algorithms.
Right. And the other side?
On the other side, you have individual investors, retail, regular people. And generally speaking, they are less sophisticated. They're usually accessing the market through a standard home broker app on their phone or a web browser.
So it's basically Wall Street algorithms going up against a guy in his living room.
Pretty much.
So how did that play out at 1:00 p.m.?
The contrast in behavior was brutal. The institutional investors reacted with extreme defensive aggression. Depending on the econometric model used, institutional sales spiked somewhere between 2% and 5.4%.
So they just dumped everything immediately.
The exact minute the bell rang. They immediately recognized the macroeconomic threat, understood that global supply chains are going to freeze, and just unloaded their risky assets. They fled.
Wow. And what about the retail investors?
Well, the individual investors showed what the study calls discordance.
Discordance. What does that mean in this context?
It means they bought and sold in almost equal measure. They were basically just crossing orders with each other, completely divided on what to do.
Wait, hold up. So you're telling me that while the smart money and the high-frequency robots were coordinating this massive unified exit, regular folks were just sitting there trading with each other, totally disagreeing on what a global pandemic actually meant?
Yeah, pretty much.
Were they just naive? Like completely blind to the abyss opening up in front of them?
I wouldn't call it blindness. The explanation here really ties into behavioral finance and something called the gradual diffusion of information.
Okay, tell me more about that.
When an exogenous shock happens, the raw news, the headline, reaches everyone at the same time.
Sure. Everyone gets the same push notification on their phone.
Right. But the interpretation of the economic impact of that news does not happen simultaneously. Institutional models can calculate in mere seconds that a respiratory virus expanding in Asia and Europe, now landing in Brazil, equals lockdowns and shattered supply chains.
Right, they have the math to back it up
Right.
instantly.
But the retail investor sitting at their laptop doesn't have a live macroeconomic forecasting model running in the background. It takes them hours, maybe even days, to mentally translate a scary news headline into an actual adjustment of a company's discounted cash flow.
Oh, that makes so much sense. It's an processing lag.
Exactly. And then there's the behavioral aspect. Think about cognitive biases.
Oh, like the ones Kahneman and Tversky studied?
Precisely.
Hmm.
Specifically, the anchoring bias.
How did that play out here?
Imagine a retail investor looking at a stock, let's say a huge bank, or Petrobras. On the Friday before Carnival, that stock was trading at 30 rays.
Okay.
Now it's Wednesday at 1:00 p.m., and the screen says 26 rays. The individual investor's brain doesn't instantly think the global macroeconomic structure has fundamentally shifted and the fair value of this company is now 15 rays.
No, they think, wow, it's on sale.
Exactly. They think this is the exact same great company from Friday, but with an absurd discount. This cognitive dissonance, this naive desire to catch a falling knife, creates buying pressure from retail in the middle of the chaos.
So they weren't trying to actively bet against the institutional funds?
No, not at all. They were just operating on a completely different frequency of information and psychology.
That real-time asymmetry is honestly kind of terrifying. The big players are systematically passing the risk down to the retail guys using algorithms.
It's the reality of market microstructure.
But this actually brings up a huge logical question for me regarding the strategy of those institutional funds.
Okay, what is it?
If the smart money is fleeing in a panic, they have to be fleeing from something, but also to something, right? Like, they don't just sell 100% of their portfolios and sit on cash.
Right, there's always a strategy.
I would assume there's a flight to quality. They must have held on to or even bought super solid, safe companies. So, did Ricardo look at how different types of companies weathered that 15-minute storm?
He did. That was actually a central part of his testing. He looked at how pre-pandemic firm characteristics affected the stock price drop. He tested for size, profitability, debt levels, and this is huge for our accounting students, the quality of the audit.
Oh, like whether they were audited by the Big Four?
Exactly. Whether the firm was audited by Deloitte, PwC, EY, or KPMG.
Yeah.
Now, what would your intuitive assumption be here?
Well, it's literally the first thing they teach you in valuation, right? Transparency and a rock-solid balance sheet reduce perceived risk.
Makes sense.
If the market is convulsing, the absolute last thing I'm going to sell is a massive, highly profitable multinational with low debt and a pristine Big Four audit. I dump the small, opaque, highly leveraged companies first.
Well, the high-frequency data shows the exact opposite.
Wait, what?
Yeah. The data revealed that young, small, less profitable companies, and crucially, those not audited by the Big Four, actually saw a mitigated impact from the shock.
You're kidding.
Nope. The market violently punished the best, most transparent companies.
That defies all fundamental logic. Why on earth would a panicked hedge fund manager or a trading algorithm punish transparency and quality? Why sell the safest assets and keep the risky ones?
It sounds crazy until you swap out your long-term fundamental analysis lens for a short-term liquidity and microstructure lens.
Okay, talk me through that.
Let's use an analogy. Imagine the financial market in that moment isn't a portfolio of stocks, but a crowded theater.
Okay, crowded theater.
And suddenly, someone screams, "Fire!"
Panic ensues.
Right. Now, the big institutional investors, they are like giant, massive people trying to fit through a very tiny exit door. They need to liquidate gigantic positions, tens or hundreds of millions of rayans in minutes.
Okay, I'm following.
If they try to sell 100 million rayas of a small cap, illiquid company, the price of that tiny stock drops to absolute zero instantly. There just aren't enough buyers on the other side to absorb that massive block of shares.
Oh, I see where this is going.
So they sell the giant blue chip companies, not because those companies are bad, but because they are the only ones with enough liquidity to handle a colossal sell order without completely breaking the market.
That is wild. It's like a massive hurricane. The Giant, rigid oak trees, the large, highly profitable firms, they catch all the wind and take the absolute brunt of the damage.
Exactly.
But the small, flexible saplings, the small, young firms, they somehow just bend in the wind but don't snap because the institutions basically ignore them.
That's spot on. The algorithms know exactly where the blue chips are. They know there's enough retail volume to buy those shares, even at a steep discount. In the first moments of panic, big players don't even bother trying to offload small, illiquid stocks because the market impact costs would just be totally devastating to their portfolios.
Okay, the liquidity argument makes perfect sense. But what about the Big Four audit detail? Why would having a top-tier audit actually hurt a company's stock in a 15-minute window?
This is probably the richest paradox in the whole thesis for our accounting audience. Look, a Big Four audit does exactly what it's supposed to do. It reduces asymmetry and guarantees high-quality financial information.
Right, it makes the company transparent.
But in a moment of absolute panic, transparency is a double-edged sword. Because the company is so transparent, the institutional algorithms know exactly how badly the global shock is going to hurt them.
Oh, wow.
The math is easy to do. The models instantly calculate how a frozen global supply chain will destroy that specific company's cash flow. The bad news is priced in at the speed of light, and the sell order is executed ruthlessly.
That is so counterintuitive, but so brilliant, because a small company without a Big Four audit is more opaque, and that opacity actually acts like a temporary shield.
Exactly.
The algorithms can't instantly compute the exact macroeconomic damage for the small guy, so they hesitate. That hesitation protects the small stock in those first 15 minutes.
Precisely. Extreme transparency meant the large companies absorbed the macroeconomic punch instantly. It's market efficiency operating in its most hyperactive, almost cruel form. It plenished the assets that were easiest to read.
Man, that is fascinating. But, okay, if the normal fundamental logic of individual companies was just totally run over by the need for liquidity, I'm super curious about the macro level. Like, how did this play out across different sectors?
Sector by sector, it was a bloodbath.
I mean, obviously, right? A health crisis hits, so things like airlines, tourism, maybe even heavy industry should logically plummet. Nobody's going to be traveling.
Right. Almost every sector took a massive hit immediately. Industrial goods, consumer goods, oil and gas, you name it.
But what about healthcare? I mean, if a deadly virus arrives, the demand for hospitals, laboratories, and health insurance is going to absolutely skyrocket. Did the algorithms at least spare the health sector?
Ironic as it sounds, no. Healthcare stocks dropped abruptly, and with high statistical significance right alongside everything else.
Wait, hold on. If health stocks fall during the opening minutes of a health crisis, doesn't that mean that fear just completely overrides fundamental logic? Like they threw the baby out with the bathwater?
It looks that way, but again, it's not about them losing their minds. It's about a sudden shift in operational priorities. To really grasp this, we need to talk about VAR.
Value at risk.
Exactly. Value at risk and margin calls. For the students listening, VAR is a statistical metric that banks and funds use to measure the level of financial risk in their portfolio over a specific time frame.
It's basically their maximum pain tolerance.
Right. It's the pain limit set by the compliance department. Now, when the COVID shock hit at 1:00 p.m., general market volatility exploded instantly. And when volatility spikes like that, the VAR limits of these institutional funds are breached immediately.
Alarms start going off everywhere.
Exactly. And here's the kicker. In heavily automated institutions, the human portfolio manager often doesn't even have a say in what happens next.
The machine takes over.
Yes. When the total portfolio risk crosses that red line, the risk systems automatically start firing off sell orders to reduce exposure. They get hit with margin calls.
Oh, man.
In that split second, the algorithm isn't sitting there thinking, this hospital chain will probably see higher revenues from COVID testing next quarter. Maybe we should hold it.
It doesn't care about the business model at all.
Not even a little bit. The algorithm is just screaming, we're too exposed to systemic risk. Liquidate assets and raise cash until we are back under our VAR limit.
Wow. So it's a completely mechanical deleveraging process. It's a blanket flight to safety.
Exactly. They needed cash at any cost to avoid breaking their own compliance rules or defaulting on their counterparties. So they sold whatever they could easily sell, including healthcare stocks, which fundamentally should have been the long-term winners.
That is just, it's mind-blowing. When a liquidity panic hits, correlations basically just go one, right? Everything falls together.
Everything falls together. The cognitive dissonance of extreme uncertainty drives a sell-everything mentality among the sophisticated players.
Okay, but was it literally everything? Was there any exception at all? Did any sector survive that initial 15-minute carnage according to the diff and disk model?
There was one clear exception, actually.
Really? What was it?
The financial sector.
You're kidding. Banks.
Yep. Banks and financial institutions were the only ones that did not see a statistically significant negative price impact immediately following the shock.
Okay, that makes zero sense to me.
Let's hear your logic.
If the entire economy is about to freeze, if people stop traveling, factories shut down, retail stores close, the inevitable domino effect is mass defaults. People and companies are going to stop paying their loans.
Exactly. The credit risk goes through the roof.
Right. So why on earth would the big banks walk away unscathed in the first 15 minutes of a news event that practically guaranteed an explosion in bad debt?
It's a great question, and it's honestly one of the most provocative findings in Ricardo's work. The thesis doesn't give a dogmatic, definitive answer, but it gives us the empirical reality. And we can speculate based on history.
Okay, let's speculate. What's the theory?
Well, first off, the Brazilian banking system is incredibly concentrated and has historically shown insane resilience during past crises. But the real critical factor here is the perception of systemic protection.
You mean protection from the central bank?
Exactly, too big to fail.
Right.
Faced with a shock that could literally paralyze the real economy, the massive institutional models likely priced in almost automatically that the Brazilian central bank would step in immediately.
To inject infinite liquidity.
Yes, to prevent a systemic credit collapse. Plus, when you look at the utter destruction of value happening in the real economy sectors, the industries, the retailers' capital naturally try to hide somewhere.
So they park their cash in the big banks.
Yeah, the banks were seen as the ultimate liquid vault. Regardless of the exact mechanism, the big banks were essentially the lifeboats that survived that first massive shockwave.
Man, this entire conversation just completely flips how we usually think about the stock market.
It really does.
I mean, for you, the accounting or finance student, the researcher, the future portfolio manager listening right now, the takeaway from Ricardo Ferreira Dantas' thesis is just monumental.
It's a reality check.
It really is.
Yeah.
It proves that the stock market is not just some neat little spreadsheet where supply and demand curves cross in a perfectly rational world. It is a messy, intense battleground of human psychology, high-speed algorithms, margin calls, and massive informational asymmetry.
That is the perfect summary. Those 15 minutes on Ash Wednesday prove that market efficiency is deeply, deeply dependent on who is trading and under what constraints. When a great company stock falls further simply because its Big Four audit makes it easier to price a disaster, you realize that short-term efficiency can look completely irrational from a fundamental perspective.
Yeah, it really does. And that leads me to a final kind of provocative thought, something for you guys to mull over and maybe debate in your next seminar at UFPE.
Oh, I like where this is going.
We just spent the last 20 minutes proving, with hard econometric data, that institutional investors have an unbeatable arsenal. They have the fiber optic speed, the teams of analysts, the automated VAR models, and the second the clock struck 1:00 p.m., they used all of that power to dump their risk directly into the laps of retail investors.
Who are happily buying the dip.
Right, anchored to their naive bargain hunting bias. So the big question is, are individual investors inherently playing a rigged game? Is the retail investor's only real purpose in the market to act as a sponge for the big whales when the apocalypse hits?
That's a pretty dark way to look at it, but it's a super valid debate. But, there's another angle to consider.
Which is?
Think about the discordance we talked about, that chaotic, uncoordinated, maybe even naive optimism from the retail side. What if that is actually the essential counterparty liquidity that keeps the whole system alive?
No,
Right, because if every single player in the market was a highly sophisticated institutional fund trying to fit through that tiny exit door at the exact same time, with zero retail investors willing to buy.
the market would completely freeze.
Exactly. The system would collapse under its own weight. So is the retail investor the victim of an information gap? Or are they the unsung hero that actually provides the liquidity to keep the gears of capitalism turning when the sky is falling?
Man, that is the billion-dollar question, literally.
It really is.
Well, the high-speed camera pointed at 1:00 p.m. on Ash Wednesday showed us the exact millisecond of impact. How you choose to use that information when you're building your own risk models, well, that's up to you.
Good luck out there.
Seriously. If you enjoyed this deep dive and you want to keep exploring the absolute bleeding edge of accounting and finance, make sure to engage with Pod Accounting.
Yes, please do.
subscribe. Share this deep dive with your classmates at the Graduate Accounting program at UFPE and bring these debates into your classrooms. Accounting only really comes alive when we question the status quo and elevate the conversation. Thank you so much for giving us your time and your ears today. Keep studying, keep questioning, and we'll see you on the next deep dive.